All right. Hi, everybody. Welcome to our seminar on cottages and the capital gains pain that is therein. We're just letting everybody filter in as the people were in the waiting room. So welcome, Rhymes. Welcome, Anne, Deborah, Gary, Jason, Christina, Paula. Welcome, Peter and Bruce. I think that's everybody so far, but welcome everybody. We have a few more people expected to attend. So as you can tell, I'm essentially killing for time here as we start our webinar. Leah, we can go to that disclaimer slide, and I can sit up there while I stall for time. So thank you again for joining our cottage and capital gains webinar. Ramari, I'm sorry if I mispronounced your name, but welcome as well. And we have a number of other people that will be joining throughout. And we'll just go to the next slide, Leah, if you don't mind. This is our team on the call here today. We have Erik, who's
everybody.
The advisor on the team. There he is. We've got Jeff Wachman, who's the founder of our team and been in the business longer than he cares to admit. And myself, we have Leah, who's one of our associates, and you may or may not have talked to her. She's in charge of our marketing and client services. And then also on our team, we have Joan, who's an associate in client services, our newest member to our team. So if we go to the next slide, we'll just introduce. Today we're going to be listening to Wilmot speak, and if anyone's had the pleasure of hearing Wilmot speak before, you know it's a distinct pleasure. First of all, he's got a phenomenal accent that we all enjoy greatly. And then he's just an extremely smart guy as well. So really welcome Colleen as well, Brian. Wilmot's has a variety of different designations. You can just imagine that he has all of them. He has a degree in math for commerce. And he's been working with CI, Global Asset Management, for some time now, at least as long as I can remember. And he's the team lead for the tax, retirement, and estate planning group, which basically means that he's the guy we go to when we have complicated tax questions, or we're looking for someone to do a really great presentation like this. I think Jeff wanted to pop on here and say a quick hello to everybody. So again, Jeff is the founder of our team, and kind of really keeps us on the straight and narrow. So Jeff, over to you. And then if you don't mind throwing it over to Wilmot, and then we'll rock and roll.
Thank you, Per. You can hear me, I guess?
Perfectly, yeah.
Oh, good. So I see a lot of familiar names, Brian Cheadle and a bunch of others. Thank you for joining. It's an important issue. It's an important asset. And, although we were talking earlier, the tax gurus have managed to really nail down many of the options we may have had in the past. There's still some estate planning that is required if the cottage is to stay in the family or be passed on to the next generation painlessly. So I know Wilmot and Erik and Per have some great strategies and things to consider so that happens. And I hope you enjoy the conference, the webinar.
Awesome. So thank you, everyone, for joining. It's an absolute pleasure to be here. Whenever I get the opportunity to speak to your group and work with the great team we have here at Asante, it's always a great pleasure. And as much as I share content with you, I feel fulfilled in doing this as well, because I get a lot of questions from you. I feel your energy as well. And the dialogue that we have in forums like this help to create new content and drum up new ideas and new strategies and so on and so forth. So thanks very much for having this opportunity. It's my pleasure to be with you. I'm going to share my screen here, and then I'm going to bring up the presentation, and then we'll get right at it. If Erik, Per, or Jeff, give me a thumbs up. Let me know that you can see the slides. Good stuff.
Looks good.
All right, good. So let's get right at it. Succession planning for the family cottage. Thanks for your patience there. There's lots to talk about with this particular topic. There's always lots to talk about when it comes to the cottage. The cottage can be a lightning rod for taxation. It can be a lightning rod for family conflict and confusion. It can be a lightning rod for challenges when it comes to settling one's estate. But all of that stuff doesn't have to happen if we put an estate plan in place. And that's what we want to talk about here today. We want to talk about succession planning for the family cottage. Be more specific. What we want to do is we want to talk about the need for a succession plan, the need for an estate plan. I think there's a stat out there that says that roughly 50% of individuals have a will, which means that there's roughly 50% of individuals who don't have a will. And what does that mean for succession planning? How important is an estate plan? We're going to talk about the need for a succession plan. We're going to talk about who should receive the cottage. Okay, well, we're talking here about the family cottage, sure. And presumably there are some folks on the line that want to pass the cottage down to their kids or grandkids. There might be some other folks who are on the line that say, hey, look, I got this cottage and my plan is to sell this cottage and sell it for as much as I can sell it for, get as much as I can and transition asset or cash or money to my beneficiaries. There's something in this presentation for you as well, right? So we're going to talk about the need for a succession plan. We're going to talk about who should receive the property. We're going to talk about taxation at death. As we walk through life, we have a partner in life. And that partner, I'm not talking about your spouse or common law partner. I'm talking about the CRA. Your CRA is your partner throughout life. And guess what? They're your partner at death as well. All right, so we're going to talk about taxation at death and how that might impact the cottage. Very big conversation nowadays, particularly because our federal government just increased the capital gains inclusion rate for many individuals. How does that impact you? How does that impact your cottage plan? Does it impact your cottage plan while you're living? Does it impact your cottage plan at the time of death? We're going to go through those concepts here today. And then we're going to talk about strategies for minimizing tax and avoiding conflict on sale or at the time of death. All right, so that's where we're going. I invite you to please ask your questions in the chat, and then Erik and Per and Jeff will handle those questions at the end, and we'll see where we end up, okay? So let's get right at it. Let's start with the need for a succession plan. Why do we need a succession plan? I'm going to get into the cottage more specifically in a minute, but it's important to note that a succession plan is not just for the wealthy, the rich, or just for older individuals. A succession plan or an estate plan is important for everyone. Anyone with assets, anyone that wants to have some say over how their assets will be distributed at the time of death. Those assets may be liquid assets such as stocks or bonds or mutual funds. Those assets may be illiquid assets like real property, right? Young families should have an estate plan in place. What happens if you have a newly married young couple? What happens if you have a young family that just had their first child or second child or young child? What happens if there's a premature death in the family? How will bills continue to be paid going forward, right? So young families should have a succession plan or estate plan. Families with minor, disabled, or spendthrift family members. Not everybody has the ability to appropriately manage assets. You might want to think about putting an estate plan in place to ensure that these family members are adequately cared for, and blended family situations can cause the need for a succession plan. But in addition to that, while we talk about who can benefit from a succession plan, it's important to talk about what tools are in place. What tools are in place to allow us to carry out this plan? There are survivorship provisions for jointly held property. We'll talk about that. There were a number of questions that came in advance about, talking about, should I add my kids as a joint owner on my cottage property? What will that look like? What are the implications of that? So we'll talk a little bit about that. Beneficiary designations for registered plans or insurance contracts can be in an estate planning strategy. Having insurance solutions in place. We were just talking with Jeff a short while ago about the importance of insurance. Insurance provides flexibility, gives you options at the time of death. For many families, they wish to have the cottage within their family and stay within their family generation after generation after generation. And that's okay if we plan for the tax liability, because the tax liabilities, you can't pass properties from generation to generation to generation on a tax deferred basis. There's limited assets for which you can do that. Qualifying farm property is one, qualifying fishing property is one. But if you've got a cottage, personal use cottage, and you're looking to transfer that to the next generation, you are likely walking into a tax bill. And how will that tax be paid? And if the taxes cannot be paid, what happens to that property? Does the CRA simply forgive that tax liability because you didn't put insurance in place or don't have any other assets that can cover the tax bill? So things that we want to keep in mind, particularly if we want to preserve the cottage across generations. And power of attorney documents, last will and testament, these are all important parts of an estate plan. When you sit down to define your estate plan, goals for many Canadians often include clearly communicating intentions to all survivors. This is what I want done. I want it to be clear to avoid the conflict that might happen later. Goal might be to simplify estate administration, minimize income taxes and probate fees, facilitating an orderly transition of assets to beneficiaries, and perhaps navigating blended family scenarios. These are all things we want to keep in mind when we sit down to define our succession plan for our family cottage. Now, specifically talking about the cottage, who should receive it when the time comes? Perhaps you have multiple children. Should you transfer the cottage to those children equally after you're gone? Or perhaps you have one child who uses the cottage more than your other children. What should the distribution of that asset look like at the time of death? Would leaving that asset to all children equally be the right thing to do, given that one child is closer to that property, uses the property 90% of the time, and the other children don't have an interest in it? And if you do decide to leave that property to one child, what will that mean for the rest of your estate? Is it your desire for your kids to inherit equally? And can equally mean a distribution of other assets to those children, as opposed to them having a slice of this cottage? These are all things to think about. Now, just a disclaimer here for a minute. My role here today is not to replace your accountants and not to replace your lawyers. I'm going to say a number of different things, talk about a number of different strategies that you might decide is good for you. And when it comes time to implement these strategies, the strong suggestion is that you work very closely with your financial advisor team. You work very closely with your accountants and lawyers to implement the strategies that you think would be helpful and useful to you. All right. So my role here today is to provide some high-level tips, some strategies, some things to think about, so that you can, carry on these conversations with your financial advisor, with your accountants, and with your lawyers. So who should receive the family cottage? Who will have rights to cottage use and when? These are things we want to think about when we sit down to define who should receive the property, whether that's being done by way of a will, or whether that's being done by way of trust terms that will define how a trust is to be used going forward with that property. Okay, these are things we want to think about. Who will have rights to the cottage use and when? Who will perform maintenance and arrange for its completion? Who gets final say on the development or sale of the property? Can a cottage be sold to third party in the future, or must it be sold only within family? And what happens in the case of a dispute? Quite often, parents and grandparents take it for granted that the kids are going to get along after they're gone. They think this is an easy distribution at the time of death. I draft a will. I've got 3 kids. My 3 kids receive everything. So the kids will inherit this cottage 1/3 each. Is that really the right thing to do? Sometimes it is. Sometimes it isn't. You divide this cottage amongst your 3 kids. But as mentioned earlier, one child uses the property the majority of the time. Will that child handle the majority of the maintenance costs associated with it? Will that child have final say on the development or sale of the property, or will that decision need to be shared between the 3 kids? Can the cottage be sold to an outsider? Or must a child who wishes to sell his or her interest sell it to his or her siblings in order to get out of that obligation, should they choose to do that? What happens if your kids can't agree? Should the majority rule? You've got 3 kids. 2 of the 3 want to go left. The 3rd wants to go right. Well, we go left. Majority rules. Okay, fine. But what happens if you have 2 kids now and one wants to go left and one wants to go right? How do we resolve the dispute? This is the conversation you want to have with your estate planning lawyer when you sit down to define your estate plan. The estate planning lawyer may very well say, well, maybe what you want to do is you want to draft a co-ownership agreement that will define how the property is to be used going forward. Who will perform maintenance? Who will have final say? Right? How the property should be sold and to whom. You can define this co-ownership agreement, and you can require the kids to sign this agreement as a condition for them to inherit the property. If they're not willing to sign the agreement, that might be a pretty good indication that there could be some challenges later on, and then perhaps you can pivot and do some different things as far as distributing this property later on. Okay, so these are just some of the softer things, quote unquote, softer things to think about when it comes to thinking about how to distribute your property at the time of death. But in addition to the softer things that we just talked about, there are the harder things, the more technical concepts that we need to address, and taxation is a big part of that. What does taxation look like at the time of death? What does taxation look like at the time of living, right? You sell the property while you're living. What do you need to be mindful of? I'm going to get into a more robust conversation around taxation in a minute, but at a very, very high level, we need to understand and be mindful that taxation follows us to the grave. Indeed, while we're living, when we sell assets, if we sell assets for more than what we paid for them, there's a capital gain, which is income, that we need to include on our tax return, and we need to pay tax on that. But what happens at the time of death? Well, at the time of death, the government says that we are deemed to have sold that asset just prior to death. So to the extent that the value of that property just prior to death exceeds what we paid for that property, or the fair market value of that property that we inherited it at, then we have capital gains at the time of death, which needs to be included on our final tax return, our terminal tax return. Our estate needs to pay the tax bill in respect of that deemed capital gain. All right, so this is the case with non-registered assets. Perhaps stocks, bonds, mutual funds held in non-registered accounts. Your vacation properties would be included in this bucket here as well. But it also applies to your registered assets, your RSPs and your RIFs. The fair market value of these assets get included on the terminal return when you die because the government says you're deemed to have disposed of it. Now, there are exceptions to the rule. The primary exception is if you leave the asset to a spouse or common law partner. That can be transferred on a tax-deferred basis. But if we're talking about intergenerational transfers, you're likely looking at a tax bill at the time of death. But in addition to that, quite often here in Ontario and a number of other provinces, you might run into this thing called probate. What is probate? Probate confirms an executor's authority to distribute estate assets. So I've got some assets, and these assets are solely held, my name solely. I've got a will. My will names an executor. My will also names some beneficiaries, and my assets might include a cottage. It might include some non-registered assets. It might include some RSPs and RIFs and TFSAs. I've got all these assets, my vehicle. All of this stuff is part of my estate. And when I die, when it comes time to re-registering or transferring these assets to my beneficiaries, the administrator for that asset, perhaps it's the financial institution that holds the asset, perhaps it's the land titles office in respect of real estate, the administrator of the asset, before they change title on that asset, they may want to see a probated will. So a will on its own may not be good enough. They might want to see a probated will. Well, what is a probated will? A probated will is a will that the government, the Ontario government, has looked at and says, yes, this is a legitimate will. We put our stamp of approval on it, and with our stamp of approval, the administrator can have comfort that this is a legitimate will, and then they re-register the asset because they have that comfort. But of course, the provincial government doesn't give their stamp of approval, this probate process, for free. They charge a fee, and the fee is based on the value of one's estate at the time of death. 1.5% for amounts in excess of $50,000. So for example, if your estate is worth $3 million, your probate fee to probate your estate is $44,250. And that's in addition to any income tax payable from those deemed dispositions at the time of death. Okay, so we have to be mindful of that. Income tax at the time of death, probate fees at the time of death. Here we have Nathan. Nathan's a widower. He has 2 children, Sandra, age 33, and Kyle, age 27. Now, Nathan wishes to transfer his cottage at the time of death to his kids. Intergenerational wealth transfer. The cottage originally cost Nathan $200,000, or perhaps he inherited it from his parents or grandparents at that cost. He put some eligible renovations into the property, which add to ACB. So let's say his adjusted cost base is $250,000. He's had this cottage for a while. He inherited it many years ago, had a lower cost base. Like I said, put some renovations into it, so his ACB is $250,000. It's now worth $1 million when Nathan dies. Okay, so what does that mean? Well, it means that upon Nathan's death, there's a $750,000 capital gain there, which translates into $248,000 of tax payable for his estate in respect of that cottage. In addition to that, probate fee, $14,250. So now the question becomes, how do we deal with Nathan's tax bill? Will the CRA simply forgive that $250,000 income tax bill and say, we know you want to preserve this cottage. We know that you want to transfer it to Sandra and Kyle. If you have no other assets in your estate to pay that tax bill with? Will the CRA forgive it? Absolutely not. Tax needs to be paid. So the question is, how do we deal with that tax bill? Is there life insurance in place to extinguish that bill and preserve the cottage? Financial advisors quite often talk about life insurance, the importance of life insurance, right? Life insurance provides flexibility, gives you options at the time of death, allows one to preserve their assets, to transition those assets to beneficiaries. If you have no life insurance, are there other assets in your estate that can be sold to pay the tax bill to preserve the cottage? Can the beneficiary step forward and pay the bill so the cottage can be preserved? Or will the cottage have to be sold? This cottage that's been in the family for generations and generations, decades and decades, will it have to be sold to pay the tax bill? Perhaps you've done some tax planning in advance to minimize taxation at the time of death. And that's the point of today's presentation. The point here is to point out the potential implications of death and while living when you handle your cottage. But a big part of that is taxation, and that leads us nicely into the conversation about capital gains taxes. I've just showed you how capital gains taxes can present itself at the time of death. We're just coming off of, and truthfully still in the midst of, a pretty significant conversation around whether or not Canada should be increasing the tax rate on capital gains. Up until June, capital gains inclusion rate was 50%. And that meant that to the extent that you had a capital gain prior to June 25th, I think was the date, to the extent that you had a capital gain prior to June 25th, a triggered capital gain, only half of that capital gain would be included in taxable income. You would only pay tax on half of it. Post June 25th, for certain taxpayers, those taxpayers being corporations, those taxpayers being most trusts, those taxpayers being individuals, once their capital gains for the year exceeds $250,000, all of those individuals are now subject to tax at a 67% inclusion rate, as opposed to a 50% inclusion rate. Was that the right thing to do? Or wasn't it? Why did our government do that? You can find folks on both sides of the fence. You can find folks that say, yes, this was the right thing to do. Canada needed to do this. I applaud the government for doing it. And then there are folks on the other side of the fence who say, terrible, terrible move. This is bad for Canada. It's bad for the economy, right?
Yeah, I think you're going to find it hard to find people on this chat, on this presentation. I think it was a good move if we're talking about selling cottages.
The Canadian Tax Foundation. In 2019, just 8% of Canadian families own stocks outside of registered savings accounts or pension plans, and 17.5% owned real estate other than a principal residence. They go on to say, while 97% of Canadian families hold some financial assets outside of the pension plan environment, pension plan environment's tax sheltered, that's why they make reference to it. While 97% of Canadian families hold some financial assets outside of this tax deferred environment, the median value of those assets is just $14,000. The Canadian Tax Foundation goes on to say the typical low to moderate wealth person has little or no taxable investment income and therefore pays little or no tax on that income. They seem to be suggesting that this capital gains tax, quote unquote, issue is an issue only for the wealthy. Well, how do we define the wealthy? How many would be captured by a change to the capital gains inclusion rate? As mentioned, there are folks on both sides of the fence when it comes to this argument. Those who argue for an increase say that the current or previously current 50% inclusion rate was inequitable as it benefits the upper income taxpayers, the wealthy. They say that a 50% inclusion rate encourages tax-motivated behavior, and the government doesn't want Canadians doing things for tax reasons. Those who argue for an increase say that government revenue is needed, especially post-pandemic, and this is certainly true. The government's been running deficits, I think, every year since they've been in office, this particular government, and we know we're just coming off a pandemic where there was significant spending, so we know that the government does need some revenue, and they have chosen to get this primarily from the wealthy. But those who are against the change to the capital gains inclusion rate say increasing the rate is economically damaging. It raises the cost of capital and discourages entrepreneurship. And they say that this whole concept of the current 50% rate being inequitable, it's not as inequitable as it might seem, because it really comes down to how you define the wealthy. It really comes down to how you calculate one's taxable income, and so on and so forth. I'm not going to get into that too much. But the point is, the government in their 2024 federal budget proposed to increase the capital gains inclusion rate from 1/2 to 2/3 for corporations and trusts, and for the portion of capital gains realized in a year that exceeds $250,000. So to the extent that you're an individual and you have capital gains that are less than $250,000 for the year, you still have a 50% inclusion rate. But to the extent that your capital gains exceed $250,000 for the year, for the amount in excess of $250,000, you're now going to have a gain subject to the inclusion rate of 67%. Okay, so how might this look? Here we have Mr. A. Mr. A acquired a rental property or a cottage property for $500,000 in 2020. He sells the property for $1.4 million on July 1st, after the effective date of this rule change. Accordingly, Mr. A has a capital gain of $900,000 on this sale. Assuming he has no other capital gains or losses throughout the year and no capital loss carryovers, Mr. A will include the following in computation of his income for tax purposes. The first $250,000 of his $900,000 gain is subject to a 50% inclusion rate. The remaining $650,000 is subject to a 67% inclusion rate. So Mr. A will have to include in his 2024 tax return $558,000 of taxable capital gains, as opposed to $450,000 of taxable capital gains, which would have been the deal prior to this change. So if we assume Mr. A is in the top income rate bracket in Ontario, this represents an increase in personal income tax from $240,000 in respect of that gain to $298,000, almost $300,000 in respect of this same gain, $60,000 increase. So the change is material. And what's material about it is many folks think about a capital gain and they think, okay, fine, when I'm living and I sell assets, I trigger a capital gain. So while I'm living, I can think about my tax brackets and think about my tax rates and sell at a time that is convenient to allow me to remain taxable at a 50% inclusion rate, perhaps, as opposed to a 67% inclusion rate. But when it comes to properties like cottage properties, right? And you sell a cottage property, especially nowadays with the cost of real estate nowadays, you might very well find yourself very quickly exceeding $250,000 in capital gains, meaning taxation at a 67% inclusion rate. But in addition to that, not only does this apply while you're living, but you might hold your asset until you die. You have this deemed disposition at the time of death that you may or may not have thought about prior to death. And all of a sudden, a large portion of your wealth ends up subject to tax at a 67% inclusion rate at that time. So for these reasons, we want to be mindful of strategies that can help us to minimize taxation at the time of death. And where we can't minimize taxation at the time of death, we want to think about strategies like life insurance to help to extinguish the tax bill at the time of death. Let's talk about some strategies to minimize taxes and avoid conflict. This slide here, before we get to the strategy, just shows us that, you know what, we've been at this 67% inclusion rate before. There was no capital gains tax prior to 72. From 72 to 87, we had a 50% inclusion rate. From 88 to 89, we went up to 67%. 1990, we actually jumped to 75% inclusion rate. We've been that high from 1990 to 2000. And then in 2000, we went back to 67 for a short period, then down to 50% in late 2000. And that's where we've sit until now, June 25th this year, back up to 67% inclusion rate for many taxpayers. Not all, because again, if you're an individual, capital gains less than 250, you still have a 50% inclusion rate. But you can see with this change, you know, many taxpayers will now be subject to tax at a 67% inclusion rate. Anyway, let's move on. Let's talk a little bit about some strategies to minimize taxes and avoid conflict. All right? I'm just watching the clock here. I want to be respectful of time. I think we got maybe another 10 minutes or so, and then we'll dive into a little bit of Q&A, okay? So strategies to minimize taxes and avoid conflict. I might go a little bit quicker here because a few things I want to make sure I cover with you guys, but stick with me here. All right, now you can maximize ACB. By maximizing ACB, you're minimizing or reducing your ultimate tax liability on sale. So we want to maximize ACB. We want to consider the principal residence exemption. Wait a minute. This is a conversation about a vacation property, a cottage property. What are we talking about when we talk about the principal residence exemption? I'm going to come back to that in a minute. You can gift or sell the cottage before death. You can do a little bit of income splitting there with family members. You can minimize your tax bill at the time of death by gifting or selling before death. You can receive sale proceeds over time to spread out your tax liability over time, up to 5 years for this type of property. We want to be careful with joint tenancy. I'm going to get into that because I know there are a couple questions about joint tenancy. We want to be careful with joint tenancy. I'm not telling you don't do it, but you want to be mindful of all the risks associated with joint tenancy before you engage the arrangement. You can consider the use of formal trusts. These are trusts that you set up. You transfer the property into the trust, and the trust will manage that property on a go-forward basis on behalf of beneficiaries. Okay, we'll talk about that. And then you can gift the cottage at the time of death via trust. We call that a testamentary trust. Now, maximizing ACB. The point here is, earlier on I mentioned that capital gains tax is based on the difference between fair market value at the time of sale or death and one's adjusted cost base. Now, renovations are quite common with cottages, and to the extent that you put capital expenditures into the property, there's a difference between current expenditures and capital expenditures. To the extent that you incur capital expenditures for the property, that gets added to ACB. Current expenditures do not. Current expenditures are more maintenance type work. Capital expenditures are expenditures that improve the value of a property beyond its original value. If the carpet in the cottage, if there is carpet in the cottage, wears away and you replace the carpet, that's maintenance. It's a current expenditure that technically would not be added to ACB. If the carpet wears away and you replace it with hardwood floor, then you can make the claim, you can make the argument that that's a capital expenditure because it improves the value of the property beyond its original condition. That would get added to ACB. The point is, any expenditures, renovation expenditures that increase the value of the property, make sure you hold on to your receipts, be mindful of these things. They can get added to adjusted cost base to minimize capital gains tax down the road. So maximizing ACB is one. Here's another one. Consider the principal residence exemption. Well, wait a minute. Isn't the principal residence exemption something you can claim on your primary residence, your quote unquote city home, the Income Tax Act does not indicate that you must claim the principal residence exemption in respect of your city home. If you have a cottage that has gone up more in value and you spend some time at that cottage each year, then you can claim the principal residence exemption in respect of the cottage as opposed to the city home, which can save your family some tax dollars. Now, you can only claim one property as your principal residence. You can't claim both, but you can decide which property you want to claim the exemption for. And the exemption is actually claimed in respect of a year-to-year basis. You don't have to do this paperwork every year. You don't have to make an indication in your tax return every year. The indication is made when you sell one of the properties. That's when you make a decision as to whether or not you're going to claim the exemption in respect to one property or the other. But the point is, when you claim the exemption, you're actually claiming it in respect of each year you've owned said properties. And only one property can be claimed per year. The point I'm trying to make, we can do a deeper dive on this later, but the point is you can claim your cottage as your principal residence if it makes sense to do so. All right, so consider that as a strategy. Gifting the cottage before death. Well, why might I want to do that? There's a lot of folks who won't want to do that, and I'm not suggesting that everybody engage this strategy. You might want to hold on to this cottage until you die. You enjoy using it. You don't want any debates around who owns it. You know, you want to use it whenever you want to use it, right? You're going to hold it until death, and that's okay. But for those who are thinking, you know, I don't use the cottage that much anymore. The kids get up there more than I get up there. I'm trying to do some estate planning, and I'd like to gain some certainty around what my final tax liabilities might look like. The kids use the cottage more than I do, so perhaps we need to accrue future growth to them as opposed to ourselves personally. Then you can think about gifting the cottage before death. In doing that, you're creating an income splitting situation, because future growth will accrue to your adult kids or grandkids. By doing this, you're reducing the value of your estate, which can save you some probate fees, because recall, probate is based on the value of the estate. If you transition the cottage before death, it does not become part of your estate. So you're reducing probate fees. You're avoiding complex estate settlements if your estate will be complex to settle. And you're demonstrating your intentions, which reduces the potential for conflict. So many folks will consider gifting the cottage before death, right? But if you're gifting the cottage before death, you also want to be mindful that gifting the cottage before death will accelerate your capital gains tax liability, right? Because again, you can't transfer it across generations on a tax deferred basis. So you're going to accelerate that tax liability, perhaps subject the property to the transferee's creditors, and perhaps relationship breakdown, and of course, loss of control. So there are pros and cons to the strategy. You just want to be mindful of what they are as you think about your own situations. Some might say, hey, you know what? I don't want to gift the cottage to my kids. I want to sell it to them. I want to sell it to them because if I sell it to them, then they're going to earn this cottage, right? And they're going to pay me something for this that perhaps I can use to fund my retirement. I want them to have some skin in the game, so to speak. So you can sell the cottage, sure, sell it to your kid. You might say, okay, fine, I want to sell it to my kids, but the truth is my kids don't have the money to pay for it. So what happens then? Well, you can still sell it to your kids, even if they don't have the money to pay for it. You can still sell it at fair market value. You can say to your kids, pay me over an extended period of time. Perhaps pay me 20% each year for the next 5 years, for example, or over a longer period of time. In doing so, it can actually be a tax strategy because there's rules in the Income Tax Act that say to the extent that you don't receive full fair market value up front, you can spread out your tax bill over a period of up to 5 years. We call this the capital gains reserve, right? And if you're able to spread your tax bill over a period of up to 5 years, then it can result in less tax payable for you as a transferor, because perhaps your tax brackets will be lower if you break up the tax bill over 5 years, as opposed to taking everything into income in 1 year. We call this the capital gains reserve strategy. But again, pre-death transfers might also accelerate taxation to the parent, subject assets to the child's creditors. Parent might lose control of this asset. So these are things that you want to be mindful of. If we do a bit of a deeper dive on the capital gains reserve strategy, it's often used for in-family sales, although it can be used, with strangers as well. Although in many cases with the transaction with strangers or arm's length persons, you might want to get your money up front to the extent that you can. We often see the capital gains reserve used for in-family transactions. It spreads the tax bill for a period of up to 5 years. How does it work? Parent agrees to sell the asset to the child at fair market value. Child pays fair market value by way of a promissory note, and stipulates that the payment will be made over 5 years. Interest is not required because it's a vacation property. It's not used to earn income, that type of thing. And it can also be offset by the child's inheritance. All right. So there's a number of benefits to doing that. Spreads the tax bill over 5 years, reduce tax liability, creates income splitting, number of transactions or benefits there with this strategy. All right. Now, here are some of the general options when considering transferring assets within a family. You can gift the asset. I mentioned this already. You can gift the asset. When you gift the asset's deemed sold at fair market value by the seller, by the parent. So the parent will have to pay capital gains tax. The child, in the case of a gift, receives that asset and their ACB is fair market value at that time. So parent pays capital gains tax up to fair market value. Child inherits the property or receives that property as a gift, and their ACB is fair market value going forward. That is what we see quite often, and that works well. The other option is to sell it to the kids at fair market value, right? Kids might pay over a period of time, or perhaps they pay the full hit up front. It's a fair market value sale. Again, parent pays capital gains tax based on fair market value. Child's ACB is fair market value on a go-forward basis. So that's very similar to the gift, except for the requirement to exchange cash in a fair market value sale. Now, what I wanted to point out on this slide is the less than fair market value sale. You might say to your kids, I'm going to sell you this property, but I'm going to sell it to you at a 50% discount. Is that good to do or not good to do? That can create a double tax problem. Because the Income Tax Act says, even though you sell it to your child for 50% discount, you're deemed to have sold it at fair market value. So you got to pay capital gains tax based on fair market value. But the adjusted cost base for your child is not fair market value. It's the price they paid, so the 50% discount. So what that is going to turn into is a potential double tax problem down the road when your child goes to sell the property. Okay, so we want to be mindful. We don't quite often see less than fair market value sales. We see gifts. We see sales at fair market value. If the kids can't pay the full hit, then, we spread out the tax bill over 5 years. You can forgive it as part of your estate, your estate plan, and so on and so forth. So this is stuff you talk to your accountant about, talk to your financial advisors and your lawyers about. Okay, I'm almost at time. I want to cover jointly held property here before we close, because we get quite a few questions about this. When we think about jointly held property, here I'm talking about joint with right of survivorship. There's different ways that you can set up assets jointly. The most common ways are joint with a right of survivorship, which means that if I own this property jointly with someone else, a joint right of survivorship, when I die, that person, in theory, inherits the entire property, receives that whole property, and it bypasses my estate, right? So the asset bypasses my estate, goes directly to that person solely, because this is joint with right of survivorship. The other way you can set up properties jointly is what we call joint tenants in common. So I own 50%, the other joint owner owns 50%. When I die, my interest goes through my estate and is divided according to my will, as opposed to my interest automatically going to that joint owner. Okay, we see joint with the right of survivorship quite often, particularly between spouses. It can also work with adult children, but there are risks, of course. You know, you want to consider the kids' creditors if they have any. You want to consider, you know, the kids are going to be involved in any decisions with respect to that cottage on a go-forward basis. Maybe you want them to be part of those decisions. Maybe you don't, right? These are all things you need to be mindful of. You want to consider what potential tax implication occurs at the time you add them. You also want to consider potential conflict at the time of death. And here's what I mean by that. Consider this situation. Here we have Mary. Mary is mom. Mom lives in Toronto. And mom's recently widowed, but she's got this property in the Muskokas, a cottage in the Muskokas that she owns solely. She's got two kids. She's got Beth, who resides in Toronto with mom, not far from where mom lives. And then there's Kim. Kim lives in Vancouver. So she doesn't get to the cottage very often. She doesn't see mom very often, but she speaks to mom quite often. And she loves mom as much as Beth loves mom, and mom loves both kids equally. Now mom has heard that you can use joint with a right of survivorship to save some probate fees at the time of death. And she's heard that it can simplify estate settlements at the time of death as well. So mom decides to add Beth as a joint owner. Beth handles a lot of mom's day-to-day affairs for her, particularly as mom ages. And Beth tends to frequent the cottage a little bit more than sister Kim just because of where she lives geographically. So mom says, look, I'm just to make things simple here, and I'm going to add Beth as a joint owner on this asset, because I hear that it can save us some probate fees at the time of death. So she adds Beth as a joint owner. Now, mom has a will, and mom's will doesn't specifically mention this cottage, but her will says any estate assets are to be divided equally between my two kids, Beth and Kim. Shortly thereafter, mom dies. When mom dies, Beth contacts her lawyer, land transfers office, all of that, and says, I'm the sole joint owner, transfer the account or the cottage to my name, and that gets done. We're talking about a cottage in this context, but also know that this can apply to non-registered accounts as well. Stocks, bonds, mutual funds held within the non-registered environment. The same thing can arise. Right? So Beth transfers the cottage to her name solely because she's the joint owner, joint with right of survivorship. Shortly thereafter, Kim contacts Beth and says, hey, Beth, you know, tough times, love mom so much, sorry to see her go. I'm just wondering, you know, with respect to the cottage, I'm wondering when I'm going to get my share of that cottage. And Beth turns to Kim and says, excuse me? I was the joint owner on this cottage. Mom wanted me to have this cottage solely to compensate me for my efforts in caring for her. And also because she knew I frequented this cottage, she wanted me to have it solely, and thus why she put it in joint name. Kim says, you're crazy. You know mom loved us equally. You know that mom would have wanted me to have my interest in this cottage as well. She had a will, and her will indicates that any estate assets are to be divided equally between us. Surely she would have wanted this cottage divided equally as well. So now we have a conflict between the siblings. How do we resolve that conflict? Perhaps they're able to talk to each other, figure it out, you know, and move on. Perhaps they can't, and then the lawyers get called. And perhaps the lawyers can't solve it, and then we end up in court. And then what happens then? How will the courts address this? Who is to receive the property? Is it Beth solely? Or should the cottage be deemed to flow through the estate and be divided according to mom's will? Well, the answer is it really depends on evidence. What evidence did mom leave to indicate her intentions? Was she clear about what she wanted done with the cottage? In this particular case, all we have is some paperwork to suggest that the cottage should be listed jointly, but we didn't have very specific instructions about what should happen to this cottage at the time of death. So thus we have conflict here now. And that conflict is compounded by the fact that there's a will, and the will says any estate assets should be divided equally between my two kids. Okay. We have precedent that has been set here before when these types of situations occur. And in the absence of any evidence to indicate intentions, the courts would likely look at two presumptions. There's a presumption of advancement and presumption of resulting trust to determine what should happen. The presumption of advancement normally applies where the relationship between the joint owners is spouse to spouse or parent and minor child. Let's ignore the fact that minor children can't sign contracts. All right. But if the relationship is spouse to spouse, parent and minor child, then the presumption of advancement should apply. If the relationship is anything other than those two scenarios, the presumption of resulting trust should apply, which means that the asset should be deemed to flow through the estate and be divided according to the will. So in this case, because Kim challenged the situation and because there wasn't sufficient evidence to confirm mom's intent, the courts can rule that that asset should flow through the estate and be divided between the two kids because the will said any estate asset should be divided equally. Now, perhaps that was mom's intention, perhaps not. But these are the types of conflicts that can present themselves if we're not clear about what our intentions are. All right. And again, this doesn't only apply to the cottage. It applies to your non-registered assets, your stocks, bonds, mutual funds held within the non-registered environment as well. These are things you want to talk to your lawyer about, your financial advisors about, and get any questions addressed. Okay. We're at the hour. I didn't touch on trust, but what I will say very, very quickly in 2 minutes, if you guys will allow me, is there are situations where we can establish trusts to manage and transition assets at the time of death or even while living. And very, very briefly, it involves an individual, call it a parent or grandparent, transferring the cottage to a trustee, someone who holds the cottage on behalf or holds the cottage via a trust on behalf of beneficiaries of the trust. And because that asset, that cottage is moved into the trust prior to death, in the case of an inter vivos trust, because you can set up before death or at death. If it's before death, you can avoid probate fees, you can avoid complex estate settlements, so that can make some sense. If the trust is set up at the time of death, because you want to control the asset and have access to the asset until death, and then at that time, put it in a trust for the benefit of beneficiaries. We call that a testamentary trust, and that can be a valuable situation too. The bottom line is you use a trust if you have concerns over how the property will be used after you're gone. And if you want to leave clear instructions for how that asset should be managed over a period of time after you're gone, then a trust is often considered. A trust is not typically used to minimize taxes. Trusts are used for control reasons, to manage the distribution of assets over time. They're not used as a tax planning strategy because any tax benefits associated with trusts have been largely removed by the government in recent years. All right? Okay, I'm just past the hour. I'm going to stop there. I'm going to hand it back over to Erik, Per, and Jeff to manage some questions if we have any, and then we'll go from there. So over to you, gentlemen. Let's see what we've got for questions.
Wonderful. Thank you, Wilmot. I mean, we've covered a lot today, so thanks for giving a few examples. And I think that really brings to light a lot of the questions that we did have. So hopefully that did address some, few that did, that were highlighted. So I want to start the conversation there. One point, I don't know if this rang true, but for everybody that's listening, if you do own a property and you're joint, for example, you own a cottage jointly, you both get to multiply that $250 capital gain rate. So technically it's 500,000 at the 250. So just a reminder there. Well, you might have mentioned it, but something that
Good point.
is often overlooked. But a good piece there.
Right.
So.
Good point.
Beautiful. So in terms of the questions, we had one on the trust. I'll get back to that, but there was one that we didn't really touch about. This question is there a way to protect the cottage from being lost in the case of a divorce or death to maintain it in the family? Wilmot, are there any solutions or any considerations with regards to that, the distribution of the cottage moving forward?
At a very, very high level, if the concern is, creditors, relationship breakdown, that type of thing, at a very high level, one of the main strategies that's used to protect properties in those cases is a trust. Moving the property into the trust. And the idea here is, okay, so there's myself and I've got two brothers. And let's assume that my dad has passed away, but my mom is still living. And let's assume that my mom had a cottage. She doesn't, but let's assume she did. And let's assume that she wanted to leave this cottage to her three kids, but she's also concerned that, one of us might go through a relationship breakdown and didn't want the cottage to become subject to division in the case of a relationship breakdown. One of the things that she could do is she can leave that cottage to a trust. And she can say that, I want the trust to own this cottage, and I want my kids to have access to this cottage and use this cottage, and my kids will be responsible for maintenance costs and so on and so forth. But the trust owns this cottage and not my kids directly. Now, because I don't own the cottage directly, and because that cottage can end up going, depending on the terms and conditions in the trust terms, because that cottage might end up going to my brother or brothers solely to my exclusion, perhaps, if it makes sense for that to happen, then you can't say that I own the cottage. I am a beneficial owner, but so are my brothers. So because I don't have absolute control over the cottage, I'm subject to the decisions of the trustee of the trust, then any creditors that I have, including a potential divorcing spouse or common law partner, right? They can't make a claim on that cottage because I don't have absolute interest in that cottage or exclusive rights to that cottage. So again, trusts are typically used as control vehicles to manage these types of scenarios. Not as tax vehicles, but trusts are typically used to protect against these types of situations, right? Now, you don't always need a trust for that, although a trust will provide some added security. But you can leave assets to kids, and if you're very clear in your will that the asset is not supposed to become subject to division on a relationship breakdown, and if you're clear about any future income from the property is not to be subject to breakdown, then that may be sufficient enough to have the asset excluded for division on a relationship breakdown. But if I, as the child, take that asset and make it a family use property, then that's when it might become subject to division, right? And for that reason, parents and grandparents might consider using a trust for some added protection for that property.
Yeah, good point on the trust, Wilmot. Just to wrap it up on the trust side, can you just briefly mention some of the other considerations that individuals might not be thinking about with regards to a trust? What I mean by that is, say, a fair market value transfer into the trust, what that means, ongoing reporting requirements, and the 21-year deemed disposition rule that individuals might not be familiar with.
Yeah, no, good point. I didn't talk a whole lot about the taxation of trusts. I just said that trusts are typically not used as a tax minimization strategy. But certainly if you're going to use a trust, there are certain things you want to be mindful of. Is there tax when you transfer this asset into the trust? Sometimes there is, sometimes there isn't. There's different types of trusts that can be set up: spousal trust, alter ego trust, joint partner trust. There's no no tax when you transfer your property into these trusts, but these trusts are to be used for specific purposes. An alter ego trust can only be used by the person who's settling the trust, creating the trust. A joint partner trust can only be used by the person who's creating the trust and a spouse or common law partner. A spousal trust can only be used for a spouse until the spouse's death. These types of trusts you can transfer assets into without triggering tax. But you might say, no, I just want to create a family trust where my family can use this asset. Well, when you transfer the property into that type of trust, you trigger tax on the way in. So there are certain trusts that allow you to transfer assets on a tax deferred basis into it. And then there are other trusts that will see a tax, tax on the way in. So it really just depends on the type of trust we're talking about. Now, once the asset was within the trust, the next question is, where does taxation fall, right? And that really depends on whether any income or capital can be paid out of the trust. In the case of a cottage, there might not be any income or capital gains on that property for years. If the cottage is the sole asset in that trust, you're not generating rental income, you're not selling the cottage, you're not triggering any gains. It might be a number of years before there's any tax to pay. Maybe up to 21 years. You mentioned the 21-year rule. Every 21 years, you got to trigger tax in the trust. That's to prevent ongoing tax deferral within the trust, right? So we want to plan around that where possible. But eventually, when tax is triggered at the trust level, that income is normally taxed at the top tax rate within the trust, or the income gets paid out and taxed in the hands of the beneficiaries, right? So certainly we want to consider the tax angle associated with trusts, but trusts are used more so for control as opposed to tax minimization.
Yeah, great point on that. I think that's a key point to remember. If control is the issue, first, if you're looking at trust, make sure you're clear on what is the purpose. As Wilmot pointed out, there might not be many tax benefits to doing so, especially given the new rules. So if it's control, then that might be a good solution.
Right.
But if it's taxation, it might be more of a burden than not. So good point on that, Wilmot.
Another question here, really easy one. So just real quick, Wilmot, can you go over the quick points of how fair market value is dictated? So if I'm gifting it to my kids and I need to pay tax on the gain up to the fair market value, how do I know what the fair market value is?
Yeah, this is a hard one. This is a hard one. I do get this question from time to time, and I don't know that I have an ironclad answer to it, truth be told. The ironclad answer is, you may need to go out and get a valuation done, right? You might need to go out and get an appraiser to come and appraise the value of the property to determine a good fair market value that you can rely on. Right? If that's the answer, if I have one of three answers, that's probably the best answer, right? But there are some other situations where, perhaps there are cottages that are sold nearby in recent years, and you look at the value of what they're sold for, and perhaps you can make a leap and say, well, their cottage sold for this much, so our cottage must be worth roughly this much here, right? Perhaps that can be used as a guide, right? There are property tax. I don't have a cottage, so I can't speak to this, but there are property tax statements, and property taxes is typically paid based on the value of properties, right? And I know for my city home, right? Like, I get this property tax statement on it that has the value of the property. Some might look to use that, right? Yeah. As their guide of fair market value. Should you? Shouldn't you? I think in these types of situations, particularly with cottages that can differ in values because a lot of cottages look different. They're built differently. There's a lot of personal touches put on cottages and this type of thing. You may have to get the property appraised, particularly if you're engaging a strategy like a fair market value to sale to kids. Right? The CRA might be looking for that to prove fair market value. If you're selling it to an arm's length individual, you're selling it outside of the family, then, perhaps you have a little bit more flexibility in defining fair market value because the outsider is likely, you're likely going to try to fetch as much as you can for that property when selling it to an outsider.
Yeah,
right?
I find, if you're selling it to a third party that's not in your family, it's pretty defensible because it's whatever a third party wants to pay for it.
Right.
So that's totally fine.
Right.
It's so it was a good point, Gary. Thank you for that. Thank you for asking that question, Gary, because knowing what fair market value is very important to
Tricky
protect
one.
yourself.
Yeah.
Yeah.
I have
What
one more on my
happens,
end here.
Go ahead, sir. Go ahead. Yeah.
Wilmot, we mentioned the fair market value exchange and the capital gains reserve, in which you can spread the capital gain for up to 5 years.
Yeah.
What about the strategy where an individual would sell a portion of their property over time in the goal of keeping the capital gains under that 250 or 500 for 2 threshold? Have you seen that in practice, and any comment on that strategy?
Have I seen somebody? So again, are we talking about a sale of the entire property up front and just receiving the proceeds over time? This is what we're referring to?
This would be a sale of a portion of, say, a quarter of the property over the next 4 years, rather than full and then gain over 5.
Yeah, you know what? I that one I'd want to think about a little bit further. I'm not saying you can't do it, but there are some other factors that you might want to keep in mind there. You know, because you're doing a partial sale, right? So what does the partial sale look like? And what are some of the considerations you need to be mindful of around a partial sale before you start to talk about spreading it over time? So I'd want to think about that one a little bit more to get my head around all pieces of that before I comment on it. But I'm not going to say that you can't do it.
Yeah. Perfect.
And riffing off that one. So if I'm saying I'm going to sell my $1 million cottage to the kids, and they're going to pay me over 5 years. So then I get to, you know, it's a good idea, because then you get to, you know, you're under that 250 every year, let's say, right? And so you're not getting at the 2/3 inclusion, you're getting at 50% inclusion. Yep. What happens if my kids don't pay me?
You can forgive it.
Can I forgive it like in year 3 or only at death?
Well, you'd want to. First of all, you're going to want to the extent that you can, right? Assuming that death occurs down the road, right? You're going to want to spread it out over the 5 years, right? Because it's a fair market value sale. You spread it out over 5 years. And to the extent your kids don't have to pay you 20% over 5 years, you just need to recognize 20% each year over 5 years. They don't have to give you all of that proceeds. You just need to recognize at least 20% per year over 5 years. So to the extent that...
So that's good, because then in a lot of situations I'm getting under that, I'm staying under that, I'm including it at 50%, and then the kids ideally would pay me something, right? But then they still have this, they owe me the money, right? Yeah.
Exactly, which can be forgiven at the time of death, right?
If you want.
If you want. That's right.
If you like your kids.
That's right. Or that can offset their, you know, again, offset their share of their inheritance when you die.
That's
right?
That's right. So Erik, keep being nice to Jeff.
That's right.
My very best.
That's right.
So there's always lots more questions on this, and this is like a real rabbit hole. Erik, do you want to, you know, wrap it up here and see?
Hey, Per,
go ahead, Jeff.
Can I throw just to be clear? So in that 5-year sale, Wilmot, are we taking advantage of the capital gains being divided up into 5 and therefore perhaps falling under the 250 minimum?
Yes. Yes.
Okay, that's interesting. That's very good to know.
Yes. Yes. So yeah, it's a good strategy for that. Yeah.
Beautiful. Well, so to put the bow on it, I just want to thank Wilmot and the CI Trep team for taking the time today. Wilmot, love the presentation, the energy, and the level of detail that you get to in a way to help everybody understand these issues. So I think really did a wonderful job in highlighting what the considerations are. And for everybody on the line, hopefully that triggered some thoughts and some considerations if you're looking at this. So really want to thank Wilmot for taking the time, and really want to stress that if you are looking at this or considering this, reach out to Per, myself, and Jeff, and we'd be happy to review this and even bring Wilmot in or bounce some ideas off to find the plan that will work for you. There's a financial side, there's the control, there's the emotional side, lots to work on and to outline when we're looking at doing a cottage transition. So please feel free to reach out. That's what we're here for. And we're very happy to have experts like Wilmot in our corner here to share this knowledge. So thank you, everybody. And thanks so much, Wilmot.
My pleasure. Thanks, guys. We'll see you again.
Thanks, Wilmot.
Thanks, Wilmot. That was great.
All righty. Bye-bye.
Bye, guys.